Hello, everybody, and welcome to this opening session of Container Exchange's 2022 Digital Container Summit. My name is Mike King, and if you've heard these not so dulcet tones before, it's possibly because I produce and host the Lodestar podcast. Enough about me. What an opening session we have in store for you today when we plan to take you up and down global container supply chains and in and out of all of those markets that you count on. Before we plow on, if you have any questions, pop them into the chat, and if we have time, we'll get to them at the end. You also have a polls tab on top of that chat, and who doesn't love a poll? I certainly do. Please try and give any of your input, and this will be fed into Container Exchange's latest industry research. But with no further ado, let's meet our outstanding panel of experts that we have for you today. First up is one of my favourite colleagues, despite his rather questionable taste in football teams that we were just discussing before we came live. Joining us from Denmark, it's Bayern Munich supporting Zenita Chief Analyst Peter Sand. How are you doing, Peter?
I'm looking very much forward to Allianz Arena live tonight also, making that record our own as we go into the 31st unbeaten home or group stage Champions League match tonight, beaten Victoria Pilsen. But as you can tell,
I hope the Champions League serves you better than the league, because at the moment I think you're coming third in a one-horse race. As the moderator, I can move swiftly on here. Switching over to the Brexit side of the channel, it's the English gentleman that also doubles as Drewry's head of research, Martin Dixon. Thanks for joining us.
Nice to join you all, Mike, and looking forward to a great discussion.
And last but not least, calling in from the States early today, which is also his birthday, it's Eric Johnson, who's JOC's Senior Technology Editor, but I also often think possibly the only person in our industry who both basically understands freight tech and is also able to explain the rest of us mere mortals. Happy birthday, Eric. It's your 30th again, is it?
Yeah, my 16th anniversary is my 30th.
Excellent.
So delighted to be joining all of you today. And thanks for the invite to the Container Exchange team as well.
Thank you, Eric. Let's push on. I'm sure everyone listening is fully aware that the world of container logistics continues to face multiple challenges. After 2 years of COVID, we still have lockdowns, which is hitting business and economic growth in China. Congestion is tying up vessels, boxes, chassis, hauliers. We've got strikes at ports around the world, a cost of living crisis. There's quite a few moving parts. War, a humanitarian crisis in Europe, inflation, disastrous weather events, and we also have container rates now plunging back to earth, and reports that shipping lines are begging for cargo. Is the boot on the other foot now? We will find out. But let's start with that macroeconomic picture. Now, the IMF and World Bank this year have consistently downgraded their forecast for global GDP growth. A number of key economies are either in recession or about to enter recession. But how is this affecting our bread and butter, the flow of containers? Martin, can you give us a quick snapshot, please? How is Drury viewing that demand picture for the global container trade this year and next?
Yeah, sure, Mike. So actually, we've just published our latest outlook for the container shipping market and our container forecast. So that was published just yesterday. And we have each quarter, when we've reviewed our forecasts for the trade, we've had to downgrade them. And this has been going on now for some time, some quarters, where we've seen a degradation in the economic outlook and the impact then on trade. And of course, GDP development is a key driver then of the container shipping trade. So as you say, all the main economic research houses have downgraded their forecasts for GDP development worldwide. And so that's impacted the trade. So for this year, we were forecasting growth of around approaching 2.5% when we forecast in the mid part of the year. We've now downgraded that down to just 1.5%. And that's a long way off pre-pandemic trend growth of around 3 to 4% per year. Now, driving that is not just GDP. There are other factors at play there. Destocking is a feature at the moment in some markets, particularly in North America and Europe at the moment. So that's dragging down the trade. So look, if you look into next year, we have downgraded our outlook again for next year. But we're now looking at growth, we think, of around 2%. So it's a bit better than this year, but not much, frankly. And then we see a bit of recovery after that. There's obviously much more detail in our published research. I think the other thing to add is that there is very high risks of further downgrades to this outlook. So if we look at the probabilities then of what we are forecasting and the risks to that, we think the risks are very much to the downside. So it's very volatile, very uncertain, many moving factors, particularly in relation to economic outcomes, but also policy outcomes in terms of government policy, how government and central banks respond to these deteriorating conditions.
Martin, how are those volume figures stacking up against that pre-COVID-19? Obviously, you said that the growth, the level at the speed of growth is slowing quite quickly, if that's possible. But how are the volumes versus, say, pre-COVID 2019?
Well, the volumes are obviously higher, a lot higher, right, in absolute terms. But in terms of growth, pre-pandemic, I mean, in 2019 was a slow year for the trade. So the trade grew at around 2.5%. It was impacted by the trade standoff, particularly between the US and China, and but also there were other trade disputes going on. But prior to that, though, there had been slightly faster growth. So the trend growth that you've seen pre-pandemic was around 3 to 4% a year. Obviously, some variations over that period. So the growth we're seeing at the moment is a lot slower than trend.
Peter, just can you give us some historical perspective on spot rates or contract rates as well, please? Obviously, those rates have certainly spot rates have really slumped this year, but historical perspective, where are we versus 2019?
Thanks, Mike. Naturally, that's the result of everything that goes on in the shipping marketplace. Where are rates right now? As they always gives you the result of whatever supply and demand, change, disruption, whatever is going on out there. That's the end game. That's the freight rates on spot. Let's begin where most drama is right now. Far East to US West Coast, and we literally see freight rates now around $4,000 per box. That's where they were also in the late days of 2020. Still elevated by at least 100% from pre-pandemic levels. So be very much aware that freight rates can still drop like 50% before they get to something that looks like pre-pandemic level. But they are back where they were in October 2020, so 2 years back. If I just illustrate the developments also on some of the other main trades out of Far East into North Europe, for instance, spot rates are still up 250% on where they were in October 2020. And again, that was already elevated from by some $500 at that point in time, starting in October 2020 at 2,000, now sitting just shy of $8,000 per day. So even though, as Martin very well put it in his opening, it's been a massively interesting couple of years, and certainly ups and downs for the rates. Let me just give you also one of the rates that seems to defy gravity, at least in the spot market. That's from North Europe down to the South American East Coast. It's up by 200% over October 2020. Right now, around 4,000, used to be much lower. But where we see also some resilience in the market is on the transatlantic, and that's of course due to all the obstacles that we still facing operators and owners and carriers, shippers of any kind in the US East Coast on the congestion side, but certainly also in Northern Europe and in the UK, Mike, where you are, Port of Liverpool being on strike right now. what's that all about? Well, I know, but well, Port Felixstowe definitely also joining in. So if we go by say the most recent congestion numbers also on that, we see a sharp rise in UK North Europe congestion. If we move on to the long-term contract rates, because I guess at the end of the day, that's where most boxes are moved. Definitely this year, but even more so next year, as shippers are desperately seeking to re-inject resilience into those supply chains that have been appallingly poor in performing the service levels of past decade. Used to be around 80. Right now, with the most recent reliability information, we are at 46. So still ample room for improvement. But shippers tend still to sign long-term contracts at very elevated levels. If we start where we also did it in the area of spot rates, Far East to US West Coast, up 200% still on where they were 2 years ago, sitting around $7,000 per box right now for the Trans-Pacific main trade. If we move to Far East into to North Europe, those long-term contract rates are still signed just about $8,500, $9,000 per box, up 460% from 2 years off. So obviously this year is a record-breaking one for the carriers in terms of making profits. The one trade that I would like to end this round the world trip would literally be the transatlantic, of course, from North Europe into to US East Coast. Also sitting comfortably with little weakness to see so far, around 7,300 per box, up 282% on where rates were 2 years ago. So still very, very elevated, but obviously the tide has turned in favor of shippers, and definitely we see that also in Sanetta rates, that the tenure and the duration of the long-term contracts have come off from a year ago, where a lot of shippers and carriers wanted to do 1-year deals, multi-year deals. Now it's the opposite. You put more volumes into the spot market and you sign longer-term contracts. So a lot of action is going on out there with the Trans-Pacific being where the most drama have been just in recent months.
Thank you, Peter. Let's zoom into that US market, if we may. Eric, a non-technology question for you, which I'm sure you're delighted to field. As Peter said, one of those trades that is defying gravity is that transatlantic trade. Obviously, the dollar is a factor there. But we've got that congestion on the US East Coast, but some of this is down to the transfer of cargo and vessel services from the US West Coast. Can you tell us a little bit more about that, please?
Yeah, absolutely. And it is strange a little bit for me to be diving into non-technology questions, but luckily I have a huge crew of editorial colleagues to brief me on what's going on the variety of things that you mentioned in the outset. So yeah, you alluded to a migration of cargo from US West Coast ports to East Coast ports. We've absolutely seen that this year, and it's primarily due to sort of the uncertainty that still surrounds negotiations between the ILWU, which is the Longshore Union covering the entire US West Coast, and the PMA, which is the negotiating body on behalf of the carriers and marine terminals on the West Coast. That contract actually expired over the summer. It's now 3 months since it expired. They've agreed to sort of continue working without a contract, but there's still uncertainty. And that means uncertainty has prompted shippers to switch a lot of cargo to East Coast ports so as to avoid any disruption that may have occurred. There's also the impact in terms of West Coast, where we've seen congestion really minimized from a vessel call perspective. There's still some congestion on the rails and inland, but from a vessel call perspective, we're seeing things return somewhat to normal. That was prompted by a lot of front loading of cargo, to beat the deadline of the contract expiration before having to reroute to East Coast, but also shippers have very short memories, and or I should say long memories in this case. They remember what happened in 21, especially around holiday shipments. They front loaded a lot of volume at the beginning of 22 so as to avoid, with longer transit times, so as to avoid key shipments arriving not arriving on time, right? So those are sort of the two big macro factors that shippers sort of influenced cargo migrating from West Coast ports. It's shipments that would normally have arrived at West Coast ports moving to East Coast.
Eric, how does this ILWU PMA standoff play out? If, say, there's a resolution, does a lot of this cargo go back into the West Coast if it's coming in from Asia, or do you envisage some of it finding traction on those US East Coast? Does that become a better option long term?
Yeah, that's a great question. We actually had a chance to meet with a big group of shippers last week at our JOC Inland event, which was about North American domestic transportation, and a lot of them have international responsibility, and it was really mixed. We actually posed that question: are these permanent shifts that you're making? Totally dependent. Some of them said, no, this is completely opportunistic, ad hoc kind of strategic move. Others said, no, this is part of a planned diversification around different gateways in North America. Others said they went in thinking this was going to be a short-term solution, but they're actually finding opportunity to better, sort of distribute from, new ports that they may not have used. There's also a fair amount of shippers who are using ports that they literally hadn't used at all, secondary kind of tier 2 ports in the US, and finding interesting kind of supply chain solutions out of those ports. So we may find, kind of new relationships that have been created. That said, there's certain supply chains that are just meant to be routed through the West Coast when it's moving fluidly. And, we've seen the impact, how quickly things can back up at the East Coast ports where there's not as much capacity as, say, in Long Beach and LA. So, I think the key is shippers are sort of now in a mode of considering all options and not just having sort of a rigid mindset about where containers need to flow, just based purely on geography.
Peter, or maybe Martin, does anyone have any numbers on exactly how significant that shift from the West Coast to the East Coast has been in terms of vessels or cargo volumes?
Well, I think if we look at the most recent numbers from New York, New Jersey, that port just beat both the San Pedro Bay ports in August, not only pushing out the empties, which they find here, there, and everywhere on the East Coast, but definitely in terms of numbers crossing over from the US West Coast to the East Coast. I think if we look at imports from the Far East, it's still the lion's share that goes in through the US West Coast. Our data points to some 55 to 56% of all volumes coming in from from the Far East. But definitely we have seen the East Coast ports really working hard, and a Gulf port like the one in Houston is almost double up from where it was a year ago in terms of throughput, in an effort to avoid all the hassles that was expected to take place on the US West Coast. So we still see some, as Eric rightly pointed to, but it's all been so far scary and well, still delivering. And I guess that's also in terms of the congestion that we have seen now, still being double on the US West Coast, but a far cry from where it was when it was at its peak earlier in the year. So I think in that relation, it's quite dramatic and quite impressive. Even though we can shout of ports being too little, too late, and having yard density exploding. But they've actually done a pretty impressive work when considering all the move around and shift in imports from US shippers.
Martin, we've heard there that the threat of a productivity slowdown or union action on the US West Coast had quite a significant effect on US logistics and US business. In Europe, it's been a little bit more serious than the threat of union action, isn't it? We've had a series of strikes in Northern Europe this summer. How has this affected liner schedules? And I guess it means we've got a lot of containers in the wrong place, maybe a lot of empty stuck at ports.
Well, it has disrupted schedules, that's for sure. So it has been disruptive, and any disruption at particular ports will have wider supply chain impacts. I think the difference, though, between that type of disruption in Europe and the disruption that may take place in the US, for example, particularly on the West Coast, is about choice. You have far more port choice in Europe, particularly Northern Europe. Also, you have that choice because there is within a given proximity quite a large number of large ports. There is also a very well-established feeder network in Europe, so it makes it much easier then for carriers to adjust schedules and still get cargo to market in a way that it is much less achievable in North America, particularly on the West Coast, where despite all the various innovations that shippers have been using, as Eric was pointing to, choices are quite limited there. And more choice on the East Coast, but still there is not this established feeder network that allows carriers to divert cargo into alternative ports very easily in order for cargo to be moved to market. I think that's probably the big difference. I think the other thing is that we've had going on in any event a very large number of blank sailings. So you're looking at a cancellation rate on both the Asia-Europe and Asia into North America trades of around 20% at the moment. We're approaching 20%. So there's quite a lot of disruption just in terms of carriers managing capacity as much as they can in order to stem the fall off in spot rates. And I think we're going to see more and more of that as we go through into 2023 as a way of supporting rates. We're already seeing carriers taking action to take capacity out by pulling services. We expect to see more of that. And we expect to see more action then from carriers to reduce the impacts on the fall in rates. But of course, this collapse in rates that everybody refers to, though, is very much concentrated on these main east-west trades. I mean, as Peter mentioned, if you look at some of those north-south trades, rates have actually been pretty strong on spot rates. And the annualized increases in contract rates remains considerable. So the market is not as weak as many headlines may depict. And the disruption that you were referring to earlier in your question, really about Europe, I think again is another feature we're going to see more and more of, particularly through this winter, as high inflation drives more discontent amongst transport and logistics workforce, and we'll see more of that sort of activity spreading.
You mentioned there, Martin, that we have these feeder networks in Europe, which does allow vessels to be rerouted quite easily or cargo to be routed quite easily. But there is always a knock-on effect when a port closed. I think we saw this in Germany earlier in the summer. We've got these strikes in the UK at the moment, Felixstowe and Liverpool. Can you give us some sort of idea what the domino effect is of a port closure like we've seen?
Yes, it does have big impacts, and you're seeing congestion rates rise in terms of vessels waiting outside Felixstowe. That's risen quite considerably, and we're seeing the same in Liverpool. We're seeing a lot of vessel diversions, so that does have an impact. It does have an impact then on container flows, and you referred earlier to container equipment availability. But the overall picture for container equipment availability is much better than it was before. Again, this was a factor that was having quite a big limiting impact on vessel capacity, and the equipment availability following the big increase in output by the main manufacturing companies has enabled better availability, including together with the slowdown in trade. And in fact, if you look at the major areas where we've had big equipment availability issues, has been in Asia, because that's the main production source region, as you know, and in fact, availability of containers there in a place like Shanghai is back to pretty much normal levels. So actually, the disruptive effects at the moment are probably less than they may have been if we looked back into last year when the trade was much more disruptive. But however, nonetheless, so disruption remains. That has an impact on effective capacity, although that will recede a bit next year.
Peter, this wasn't really one of the questions I ever thought I'd be asking, but saying in Europe, we've got threat of nuclear war hanging over us, of course. Events in Ukraine are casting this really dark humanitarian shadow. But can you, our bread and butter here is container logistics. How has this been affecting European container logistics?
Well, if we just look at the sheer volumes moving into Europe, you would not imagine that we are talking about massively congested ports in North Europe and still problems getting the boxes to move internally in Europe. Volumes being down by approximately 5% in the first 7 months of this year as compared to last year, and next year they're unlikely to grow again. Part of this problem, of course, is exactly what you allude to, Mike, here, that we have multiple stranded Russian boxes sitting where they should not be sitting. That's literally several places in Denmark where I am today, but also in Rotterdam, around Antwerp, to some extent also Hamburg, which used to be the big transshipment hub of cargo heading into St. Petersburg and Russia. Some boxes they did not stop in due time, so they're just taking up space and of course making it more difficult for normal logistics to take place. And then of course the fact that some carriers are omitting calling ports that they would otherwise be calling. Just like Martin said, there are multiple options here, but the problem is also when some carriers go 2 ports only instead of 3, for instance. The port of Rotterdam finds itself more congested than perhaps ever before, even though volumes are considerably down also into to Rotterdam, due to a lack of truck drivers, due to a lack of, say, different modal options. The low water level on River Rhine that used to take a lot of boxes out of the Rotterdam area every single day, of course, impaired also those alternatives. And when a big box ship arrives with more boxes than a small ship and a larger exchange of boxes when it's docking, it just takes more time and it just cramps up. But it's the one thing that we, I guess, have to deal with as long as the Russian invasion of Ukraine is affecting us, and more so, because also the alternative over land route from inland China to parts in Europe, the railway options that used to go via Russia is, of course, the northern route has been closed for half a year now. Plus, the middle route seems to be deployed somewhat, but again, it rests very much on the rationale behind the number of, or basically the subsidies attached to it from the Chinese local authorities, as well as the spread between the alternative right now with ocean freight rates coming down fast and considerably. You would hate to pay $25,000 for railway or railway service out of China to Europe right now. So I guess a lot of shippers is definitely also considering the alternatives and the options. Air had its fair upside during COVID years, also not only for personal protective equipment, but also as a reliable alternative, and the split between ocean and air wasn't that overly expensive anymore. So if you could, that was one of the options. So definitely, it's an emergency situation, especially around Black Sea naturally, but certainly also the eastern part of the Mediterranean. But rest assured also that there are still cargo moving into the Baltics, the Black Sea naturally from some of those far eastern carriers that may not have the same political pressure that is exerted on European carriers, for instance, making that global business available to carriers that have a difficult opinion or a different opinion, or avoid taking stance on the situation in Eastern Europe. So I think going forward also, geopolitics is one of the tricky things to watch out for, and again, very, very difficult to predict the adverse conditions of geopolitics.
Thanks for that, Peter. Eric, there was multiple signs that inflation was becoming a macroeconomic issue before Russia invaded Ukraine. I remember interviewing someone who was telling me in a lot of more detail I can probably explain now that shipping costs alone were adding something like 1% to US in inflation. We've since that invasion in February, we've seen a number of effects. We've seen inflation continue to surge in many countries. Obviously, some of this is driven by food inflation. The Black Sea plays a major role in grain markets. But let's look at energy costs. Can you explain how higher energy costs are impacting the transport market or the logistics market across all those modes?
Yeah, so I'm going to give a bit of a North American perspective on outside of ocean. I'm not as familiar and would definitely encourage Peter Martin to chime in if they have any sort of more granularity on in Europe or Asia. But certainly we've seen the volatility of energy markets bleed into transportation. Obviously, I think most people who are tuning in probably recognize that fuel is a massive input cost into any sort of transportation provider's total cost picture. Certainly in ocean, it's been a massive percentage of the makeup of their costs. Less so as rates rose, right? So, or I should say, it was less of an impact as rates rose than it's traditionally been. As the rates have started to compress, at least on the spot side, we're starting to see fuel take a bigger proportion of that. So I think we'll start to see that fuel surcharge, which is already quite onerous through the rest for most of the year, start to look a little bit bigger in sort of relief next to the base rates that shippers might be getting. But my S&P colleagues in Platts who put together a sort of bunker index showed it seemed to crest a bit in August and has come down since late August. For whatever reason, I'm definitely not an energy expert or analyst, so I just have to play one here in this esteemed panel. But I think if we look at the volatility in energy costs, it sort of is going hand in hand with the consumer. I don't think you can sort of extricate one from the other. You have the transportation providers wrestling with this sort of highly variable cost, and traditionally it's been the shipper having to account for that as well. But now shippers also have to worry about consumers' own energy costs, right? In Europe, you guys are seeing massive increases in your own utility bills each month. Does that cut into discretionary spending that bleeds into less spending on goods, right? And does that sort of move upstream into dampening container demand? So I think it's a picture that is it's sort of, fuel has always been sort of this thorn in the side of logistics practitioners. And I think now it's going to start to become in more relief relative to sort of normalizing base rates. We'll see it sort of become that much more prominent.
Thanks, Eric. Yeah, as you say, those fuel energy prices across the board have come off mostly a little bit since the second quarter, but they're still at relatively high levels, and that's true for jet fuel. It's I was going to say petrol, but it's true for gas. It's true for diesel, and we've also seen in Europe, and I don't know if it's true in the States, we've seen that spread between the cost of petrol and fueling your vehicle with electric sort of narrowed quite significantly. Martin, Peter, do you want to add anything here?
Mike, I forgot to address the trucking issue in the U.S. So sure. Rates in the U.S. on the trucking market have declined, but with fuel costs higher, especially through the summer, we saw a huge proportion of the overall cost to shippers go toward fuel rather than their per mile rates. So the cost to shippers didn't really, it came down a bit, but it varied very little relative to what shippers were traditionally paying. It was just much more for the fuel and less for the sort of base rate on the truckload side. So sorry, I wanted to throw that in before you.
No, that's a market that's pretty critical.
Mike, if I can add just a
yes.
brief comment. Yeah, some of the data, of course, is also found on the Senator platform. Fuel surcharges that definitely seems to take up a larger share right now, and also in coming months. Not only due to base rates falling, but also due to fuel prices being much higher than they were earlier in the year, especially on the Far East to US West Coast. We see quite a significant jump. Fuel surcharges up around $900 per box. So you can easily see that that's approximately 1/4 of the freight of all kinds, all-inclusive freight rates right now. So without doubt, the fuel surcharges are the ones to watch out for also going forward, and also to have on your mind when talking about rates falling, because that seems to be going in the opposite direction. So just wanted to add that, Mike.
Okay, that's great. Martin, is there anything you want to add?
Well, what I would add, though, is that whilst all attention is on these fuel surcharges and the impact of the energy crisis on fuel costs and energy costs generally, actually crude oil prices have actually fallen since their peak. In fact, they've fallen back down to the level they were at before the end of last year, for example. Now they're likely to rise because I think the OPEC are looking at cutting back production in order to better support pricing. So we all see some of that come back. But if you look at the overall projection at the moment, is that it's more a mild development for crude oil prices, which will feed then obviously into the settlement of bunker costs. But certainly it's a higher proportion of the actual rate at the moment, particularly given rates have fallen. That's sure a factor, and will therefore have a bigger impact then on changes in rates going forward.
Yeah, so that's actually sort of keeping them slightly more elevated if you're looking at all-in rates than they might otherwise have been. Peter, just let's look forward and stick with container spot rates. We've still got a lot of supply chain bottlenecks. What sorts this out is we've got supply chain bottlenecks as rates are falling. Is this a demand side problem? Will all of these bottlenecks go away? And if they do, what happens when all these ships come in?
I think in short, it is very much a demand side problem that was put on top of us in the industry from very aggressive monetary policies in the early parts of the COVID years, mainly by American policymakers, and that of course resulted in this whole schooners that we have in the market right now, because US imports were up 27% and European imports by 4%. So what carriers needs to do now is to unwind and bring those ships back, and surely they are not needed on many of the trades, especially in the early first half of October here. Data that I've seen from Sea Intelligence tell about 50% blanked sailings for the week following this one, as a clear indication of desperation amongst the carriers, I would say, that they are cutting, perhaps not too little, but definitely too late if they are to stop this bleeding of the spot markets, but at the benefit, of course, of global shippers right now. So I would say that carriers have their work cut out, and that's one of the things that at least I've been trying to highlight a couple of times when talking about the potential normalization of the market, that shifting global networks around, like has been the case during COVID years, it takes an awful lot of time. When you have one ship servicing one trade, Far East to Europe, it takes 70 days plus, regardless of what you need to do and where you need to bring that ship into a new circulation. But I would expect the importers and exporters of Africa, for instance, to cherish this new development, as they have definitely been the singled out losers in the race for capacity during the COVID years. So I would say demand is now coming down. We see the American consumers being pushed into the corner by the Federal Reserve Bank of US. They're ready to bring upon the American consumers a recession if need be, to fight that inflation rate. So obviously clear headwinds ahead of us, as well. Senator also expect demand to fall most likely again in sheer volumes next year. And when we're combining that with a rapidly increasing fleet in terms of nominal capacity coming from the Asian shipyards, but certainly also easing congestion down 50% from where it was tied up around the main ports from earlier in the year. It's definitely also a part of the say the catalyst behind the most recent developments here, Mike.
Martin, can I just bring you in here? What in your view happens next? I mean, I think through a lot of the last 2 years of COVID, there's a lot of people assuming that somehow Lines had worked all of this out now. We wouldn't see any dash for market share and rates couldn't crash again. There's been too much consolidation and they'd learned better. We seem to be in something close to free fall. Does this continue, or what's your view on this?
Well, I think this is the $6 million question, really, is what are carriers going to do and when are they going to do it? And I think our jury's view is that we expect carriers to do something with capacity to prevent the collapse in rates. So we have seen rates fall, but to a large extent, this is a feature of a normalizing market. Rate levels were unsustainable where they were, so they have clearly corrected. But as Peter indicated, they've perhaps overcorrected, and the reduction of capacity has been too slow. So those pressures are on these carriers, but we think that the decline in rates will slow. We expect to see a decline in rates through the course of next year, but that decline in rates will still leave rate levels well above pre-pandemic levels. Also, I think whilst there are all these headwinds, and they are significant and they are very, very uncertain, I think the other thing to note, though, is that there are all these supply side uncertainties taking place. There is a big race to decarbonize the fleet. There is big pressure then on carriers to scrap older tonnage, and they've been holding on to tonnage over the last few years because of very high demand levels. And while it is true to say that congestion and disruption is easing, there is still huge risk that it could arise again. You still have China with its very strong public health response to COVID, which is leading to these shutdowns of economic areas and communities and affecting ports potentially. That still hangs over the business, over the industry as well, in terms of the disruption that would cause and the soaking up of capacity that would have. And also, we've still got this ongoing geopolitical risk with war in Ukraine, as we've referred to before, which creates more risk and potential disruption. So I think going forward, whilst you have these big economic headwinds ahead of us, there's also this disruption factor, which is still sitting there in the background, which could still come to the rescue of the carriers.
Mike,
Martin,
Mike,
sure, jump in, Eric.
Yeah, so just to add a couple things, I think, if we think back to around April of 2020, that might be an instructive period to consider. We all thought, I think, justifiably so, that it was going to be a pretty difficult period for carriers to navigate, with everyone sitting at home and us worrying about the future of the world and the human race. And carriers were extremely responsive in managing capacity. And so I think, as Martin and Peter both mentioned, rate levels have certainly come down, but they're still at fairly elevated levels, both on spot and contract. And so they're still if you put someone in a time machine from late 2019 and drop them right now, they would say those are healthy rate levels, right? So a lot of this is psychological. There's a psychological component to the market that sort of leads people to think that we're sort of in this doom spiral from a carrier perspective. But they showed before that they can be pretty strong in terms of managing capacity in a way that they haven't been before. So I think we just need to bear that in mind. Doesn't mean that they won't sort of engage in kind of market share grabs that were sort of characteristic for the market for the last couple decades, but we have a fairly recent marker to look back on, or reference point to look back on, and say, well, they showed that they can manage capacity in very unusual situations. So,
Martin, given all of these dynamics, can I just get you to focus in on the supplying of containers themselves? During COVID, with production went into in China mostly went to a new level. As all of these supply chain issues resolve themselves and demand drops, what happens to all of those boxes? Are we going to have a glut?
Well, certainly the fleet currently is that there's an overhang of containers in the fleet, and we're seeing more of these containers being retired, and we expect that process to continue through this year and well into next year. So the fleet grew 13% last year, according to Drewry's estimate. So it came to about just under 50 million TEU. And we saw record production last year of over 7 million TEU. So this year, we think the fleet growth will be much, much slower. It will be around 2.5%. And next year, we think actually it'll probably flatline. The big driver with this slowdown in the fleet is not just about production being slower, it's about the retirement of these older containers. But don't forget, owners, carriers held on to older containers through this very highly disruptive period. And these are now being released into the secondary market as they come to the end of their useful life as maritime containers. And that pace of that will accelerate over the next few months and quarters.
Peter, just staying in China, we're running a bit short on time, so I'm going to try and fly through some of these last issues that I want to get to, or Eric's going to miss out on technology, and it is his birthday. So, Peter, just quickly, China, can you roughly run through what impact China's zero COVID policy has had on supply chains and the ability of manufacturers to produce goods in a timely manner and get them to port?
Definitely, what we expect at Soneta is still rolling lockdowns in China, very much affecting the transportation in the hinterland, because these truck drivers still find themselves in a very tricky situation, in need of constant reassurance of authorities that they do not carry the COVID virus. So what we see from China is troubling for those producers and manufacturers of goods from north to south in inland, of course, in China, but very much so has been the case also. The effect or the ripple effect into the global supply chains has been little to a large extent. It has been much more, giving directions, the ability of the receiving ports to handle the number of boxes. So rest assured that we will still see rolling lockdowns also in main ports. I'm not calling out Shanghai here, but it could be the case that we will see still ports close down their perimeters, while of course publicly saying that everything is fine. You can do whatever you can and will do in a normal port, but the problem rests on the hinterland connectivity, and I think that's the risk that we should look out for in the coming month as COVID will take another swell at China, perhaps also at the West.
And Martin, Eric, do you think if Xi gets his expected third term rubber stamped in the next few weeks at Congress, do you see a change in policy in China there with that zero COVID?
No, we don't really. I don't think that changes the situation. I think China has their policy on this. There's been speculation of that, but I think it's probably wishful thinking. So as I think Peter alludes to, we're still going to see these rolling lockdowns, and it will have an impact. And I think actually, in terms of the impact on the trade and capacity, whilst it's a huge inconvenience, obviously for BCOs and shippers moving cargo, the capacity restraint effect will help in terms of the influx of new vessels coming into the market.
Eric, I'm sure like me, you've been writing about nearshoring and reshoring for many, many years. We all sort of thought maybe there was a trickle as the US-China trade war kicked off. Are we going to see that trickle turn into a flood due to zero COVID policy, and maybe throw in geopolitical risk with Russia and Taiwan?
Yeah, certainly I can recall writing stories 12, 13 years ago about China plus one, China plus two strategies, right? So this, the idea of diversifying away from China is certainly not anything new. I'm stealing a bit of a line here, but there's a famous phrase about reshoring or nearshoring that it sort of shows up everywhere except in the data. And the reality is China sort of had built up this capacity as a very sort of plug and play sourcing region for so long that even as labor and resource costs rose over time, it still made so much sense to base production there. And if you strip out the zero COVID policy, a lot of that still exists, right? It's very difficult to move global supply chains on a dime. I think what potentially changed over the last year, both in terms of kind of supply chain lengthening transit times, bottlenecks from demand, and then that sort of boomerang back to what we've seen with lockdowns and production kind of interruptions in China is you're starting to see shippers take a new kind of stance on risk tolerance. So last year the big discussion was cost, but really the bigger, and my colleague Peter Terschel actually just wrote something about this last week. The bigger long-term impact is how much risk are shippers willing to take. So there's going to be a lot of shippers every shipper should be going through this examination. There's going to be some that say, we're fine with the risk tolerance that this presents because everything else makes so much sense for us. There's others who are going to look to definitely diversify, but that tends to be more, other countries in Asia, Vietnam, Indonesia, India, rather than bringing back, a full-scale production back to the Western Hemisphere, to Europe. Mexico, to take North America, for instance, has huge promise, huge potential, but it's not without its own, logistical problems. It doesn't have the logistics infrastructure that Asia and certainly China do. So, I think it's often been framed as this sort of either or binary choice for shippers, and it's certainly not that. They've been thinking about these things for a very long time, and a lot of shippers were moving some production out of China even before COVID, even before the tariffs hit in 2018. And that's going to continue and maybe accelerate, but off of a very low base.
And Eric, just turn into technology. With all of this disruptive turbulence that we've seen these last 2 years, has that built up momentum for new technologies in our industry?
Yeah, it took 45 minutes or 55 minutes for us to get to the most important topic here.
Happy birthday.
Yeah, thanks. So it's interesting as I sort of sit back and think about this. If you talk to technology providers, they said they all sort of unilaterally or unanimously reported huge growth in volume and customer counts and shipments managed and those sorts of metrics they use. If you talk to shippers, it's not necessarily the same type of uptake across the board. So I think there's somewhere in the middle, right, where there was a huge amount of uptake of technology just based on everyone being distributed, everyone realizing things that, were done with spreadsheet or paper could be digitized. And so some of those plans got accelerated. A lot of plans got pushed to the wayside because people were just fighting fires every single day for the last year and a half. But in terms of two specific areas, I think one thing that's been super interesting to think about from a procurement perspective is you just have a bigger range of options as a shipper than you ever had before. And certainly pre-pandemic, you have a huge number of indexes that are out there, both Drewry's and ADA. We're part of an S&P, they have their own indexes. The amount of index data around rates that's available right now is light years ahead of where it was even 5 years ago, much less a decade ago. You have instant quoting tools, both from carriers, from forwarders, marketplaces. Some of those are even guaranteed against certain sailings. Some of them are guaranteed mutually committed from the carrier and the shipper. So there's certainly more uptake for these tools than there was before, but I think the most interesting thing to me is it's the range of options to go, which can be confusing, but it's just a lot broader now. And then the other one I'd mention is visibility. I think it's rare that a week goes by that that topic doesn't come up in conversation with shippers, and we've certainly seen the number of shippers sort of decide on the back of these extreme bottlenecks and lengthened transit times for their shipments that they needed more insight into key milestones. Not to say this isn't anything new, right? I've been reporting on visibility for as long as I've been in this industry, but it seems to have been invigorated by the pandemic, and also a lot of money was funneled toward visibility providers over the last decade. So they ought to have built something a little bit better than the previous version.
So to quote Boris Johnson, I can have my cake and eat it, visibility and pricing. Finally.
Sure. Yeah. It might not be the best tasting cake, but you can eat it.
It seemed apt on this particular day for you, Eric. Very quickly, we've got a minute each. Martin, starting with Martin, then Eric, and then Peter. Please, biggest cause for optimism in 2023 if you're in the business of container logistics, and biggest supply chain risk?
Well, I think it depends on your perspective. So if you're talking from an industry perspective, a shipping line, forwarder, then supply chain disruption, continued COVID policy in China, decarbonisation, rising geopolitical risk, all those factors will buoy the market and will support rates more than you'd expect looking at the market at the moment. If you're looking at from a BCO shipper's perspective, rate levels are falling. They'll fall further next year. That's good for them. But rate levels will certainly be well above pre-pandemic levels. Also, availability for access to capacity is much improved. And we'll see, hopefully, some easing of some of these supply chain congestion issues. Just one other thing, Mike, just to mention, there has been a big change in sourcing patterns out of China. If you look at the US, the proportion of Asian imports into the US from China has fallen notably over the past few years and has risen significantly from Southeast Asia. So there has already been changes taking place. However, many of these changes were taking place before the COVID, before the trade disputes between China and the US, and the current standoff that we're seeing between the powers. Okay?
Yeah, thank you, Martin. Peter?
I think there's definitely room for optimism going into 2023, and very much so, because we would love to have much improved reliability and much improved predictability injected back into the global supply chain. So much needed resilience. I expect to still be what every shipper is seeking in terms of 2022 Christmas gifts. So lower prices, of course, and also more options for shipments on a global scale, as carriers have spent a lot of money trying to invent new products, be it into more new ships, being wider logistics, or be it into air cargo services. The flip side of the year in terms of risks, I would call out geopolitics as a main threat to say East supply chains going forward. Naturally, the unrest of Eastern Europe, but certainly also the increased tensions around Taiwan, where we see U.S. and China going head to head. So only a few people still recall the trade war as something worthwhile taking note of, but I think we should still have in the back of our minds that it is going on at full throttle. President Biden have changed literally nothing. He has literally also, well, he put it in different terms, but he have strengthened the rhetoric, I think, about China. If we focus finally on the carriers themselves, I mean, we got IMO 2023 coming up. That is all about the efficiency of the ships complying to tighter greenhouse gas emissions. I foresee that to be a non-event, but let's see how it pans out when everything else is up in the air also for 2023, Mike. And for you, still a job and all the best for that Low Start podcast in 2023 as well.
Oh, thank you, Peter. And Eric?
Yeah, I'll go quick. I know we're up against time. So again, like Martin said, depends on the party. So if you're a shipper, I think something to be optimistic about is you somehow managed to remain viable at rate levels that seemed absolutely preposterous 30 months ago. So maybe the old "what doesn't kill me makes me stronger" adage applies. If you're a carrier, you have a financial buffer that you thought would have been preposterous 30 months ago, right? So I've sort of joked that it's like every single shipping line had a rich uncle who died and left them money that they were not expecting. So now it's about how you spend that inheritance. Are they going to be able to manage that capacity in a way that they did in 20? And then on the risk, honestly, I think the biggest risk is just, does this malaise that we're seeing right now, is this a temporary thing, or does this become a long economic malaise that hits trade volumes and consumer demand, which honestly doesn't suit either party on shippers or carriers. So
certainly a lot of challenges ahead. Martin, Peter, Eric, thank you very much for joining me today.
Thanks so much for having me.
We don't have any time for questions. We're bang on time though. If you've got a minute, please rate this session via the link in the chat, unless of course you didn't like it, in which case just please forget that message from the organisers. The next session starts at 1 p.m. CET, and this is about the ins and outs of container trading, a roundtable discussion with Danny Denboer, who is the director of C-Cube Containers, and Andrea Monti, the CEO of Sagacey. This session is moderated by Christian Roloff, CEO of Container Exchange. Enjoy your lunch break, everyone. You can schedule as many one-on-one meetings with other attendees as you want. And from all of us on the panel, thank you very much for joining us today.